Hello, Beck from To Reduce Mortgage Brokers. I just want to pop in and have a quick chat about what's going on with lending at the moment, and particularly there's a lot of information in the media. There's a lot of spotlight on banks and the Banking Royal Commission, and people are hearing that it's much harder to lend money at the moment. It certainly is. Unfortunately, it is much tougher than it has been in past. What is the focus is on at the moment is on living expenses and making sure that you absolutely can afford your loan beyond a shadow of a doubt. So we've got auditors, we've got APRA, we've got ASIC, all looking at lenders at the moment. Quite often they've got people in their office, and we're hearing assessors saying they're not quite sure, so they're erring on the cautious side. Give you an example, I had some clients recently who were doing a large renovation. As part of that renovation, they're doing some fixing up and tidying up at home, and the last couple of months they've been spending quite a bit of money at the likes of Kmart and Bunnings. When the assessor looked at the loan submission that we did, which is in fact for an extension to the home, so it's in line with the work that they've been doing, the assessor looked back over their last 3 months spending history and found that they had been spending that money that we talked about in those places, and what they sort of indicated is they can't tell whether or not that might be their regular habit or whether or not that was a one-off event. So for the last 3 months, because they'd been spending so much, they actually took the average of the last 3 months spend, which looked like about $6,000 a month as their basic living expenses. And then the loan didn't pass what we call servicing any longer. So the loan wasn't approved because the lender couldn't prove beyond a shadow of a doubt that those clients can actually afford the new borrowings that they're looking at. Now these are perfect clients with an existing lender who've never skipped a beat. So there's nothing to indicate that they can't actually afford the loan that they're looking at, and it was only a fairly small relatively small increase to their loan. But this is the environment we're playing in at the moment. So what I would say to you is, I'm going to ask you also to use caution in your spending particularly, and in your borrowing habits. So if you know that you're going to be borrowing some money, or you're thinking about buying a new house, or you're thinking about doing an extension, what I'd ask you to do is in the lead up, keep your expenses quite trim. If we can show very clearly to the lender that you can live quite economically, then they're going to have a lot more comfort in approving you, because they're looking at really heavy focus on your basic living expenses. So reduce and remove any unnecessary credit. If you've got a $20,000 credit card limit and you only use 2, drop the limit right down. The banks use the full limit when they're assessing your affordability. If you have a habit of eating out and you're entertaining a lot, maybe you might like to curb some of that for a bit. We also know that from 1st of July, the positive credit reporting regime is coming in. And what that looks like is the lenders will be getting information on your regular repayment history, not just your negative repayment history. So that means that they'll get reporting that says, always pays on time, pays moderately late, pays quite a bit late, and regularly pays very late. So this is stuff that can impact on you even if you're not in default on your loans. It's potentially also going to report when you're going over limit on cards. So we've got to be really cautious now about keeping our limits modest, keeping our spending modest, tightening the reins, and thinking that lenders might be looking back as far as 3 months to look at your average kind of living expenses. What we as brokers absolutely know is that clients will sit in front of us all the time and say, you know what, I've just been living because I've had the money, but now I want to do something with my good income, and I want to buy a house to sort of force myself to save. So we know this. We know that when you've got it, you might spend it, and that when you have something worthwhile to spend it on, that you're going to rein your life in. Unfortunately, the lenders have to work on worst case scenario, and that's kind of the environment that we're dealing with at the moment. So it's not all doom and gloom. It is tougher to get a loan at the moment, and some lenders are much tougher than others, but there is money available. We are seeing some really economic home loan rates, which is fabulous. The recent activity that really curbed investment lending, and particularly investment interest only lending, has been loosened somewhat. So we are now seeing investment loans come back to the market. We are seeing interest-only loans coming back to the market, albeit a little bit with a change in the way that they're being assessed. So lending is happening. It's not impossible. Speak to a broker. We can introduce you to a wide range of lenders, potentially some that you've never heard of before, and who might have a really fabulous solution for you. Thank you.